In this video, I want to talk about some myths and misconceptions about options trading and options flow. By the end of this video, we'll hopefully have set the record straight on a few topics. The first myth/misconception is that you can positively identify buyers and sellers in options flow. The reality is that we can never know with 100% certainty if an option was purchased or sold. We can attempt to use the price that the option transacted at and its relationship to the bid and the ask price in order to try to analyze the trade activity. Traders will generally assume that a transaction occurring at or closer to the ask price will be the result of a buy transaction, and that a transaction occurring at or closer to the bid price will be the result of a sell. But again, we would only be making an assumption here. We can often feel very good about our assumptions, but 100% certainty is not achievable. Here's an example that should open your eyes to this. So let's assume that you placed a limit buy order for this contract at 258 with the bid ask sitting at 258 and 259. A trader decides to fill your limit buy order at your price of 258. So this trade would show up in the feed as a sell call solely due to the fact that the contracts traded hands at the bid price even though they were quote-unquote bought. While we're on the subject of discussing contracts being bought and sold, please make sure you understand that options can be bought and sold to open as well as bought and sold to close. I'll put a link in the description box to a blog post detailing this subject, and it's likely one that we'll touch on in a future myths and misconceptions video. This next one is more misconception than myth, but it is that high volume or high open interest in a contract is bullish for calls and bearish for puts. The reality is that there is much more to options trading and flow analysis than just looking for high volume or high open interest contracts. Volume and open interest are two of the most valuable data points in options trading, but they both require context. Let's take a look at this contract that we can use as a straightforward example. WBD 18.5 strike calls, which expired on August 5th. So note, WBD reported earnings on August 5th in the pre-market. Here are two true statements. On August 4th, there was 20,000 volume, give or take. And on August 5th, there was 20,000 open interest, again, give or take. Now we need to ask ourselves, how did this large volume come to be? So let's take a look at the flow data for August 4th. You can see that all of the call volume was taking place at or around the bid price. As mentioned in the first part of the video, we can only theorize about buyers and sellers, but it certainly does look like someone decided to sell 20,000 calls the day prior to earnings. The open interest went up by 20,000, and as you can see, the calls lost all value overnight. Let's revisit those statements and add some context to them. On August 4th, there was 20,000 volume, which took place at the bid, giving us the impression that these calls were being written or sold. On August 5th, the open interest increased by 20,000 as a result of calls written from the previous day. In this situation, both the high call volume as well as the high open interest were bearish indicators. It just requires a little bit of digging in order to make this determination. The open interest change feed can help you analyze the overnight activity if the change in open interest is something that interests you. Just keep in mind that it's not always easy to determine if volume and or open interest is bullish or bearish. For this WBD contract, it's fairly easy to come to the conclusion that the volume was due to call writing, as it seems to have come from a single trader. This lucid flow here looks kind of similar in both volume and open interest, but it's not as clear as with WBD, given that there is a mix of both bid and ask side activity. At the end of the day, I would conclude that similarly to WBD, this volume and increase in open interest is due to a trader selling 10,000 calls. You can access historical volume and open interest data for every options contract on the Unusual Whales website, as well as access this data for free via the Unusual Whales Discord bot. Let's talk about the last myth or misconception, and that is that most options expire worthless. So the reality is that this myth was born from a statistic which states that only 7% of options contracts are exercised. But just because 7% of contracts are exercised doesn't leave the other 93% to expire worthless. Instead, of the remaining 93% of options, about 70% of them are closed out prior to expiration. So this would leave about 23% of options that expire out of the money and worthless. I hope you enjoyed this video and took something away from it. Make sure to check us out on Twitter at twitter.com/unusual_whales and at www.unusualwhales.com.